Hi friends, now in this session we will revise the first two chapters of Portfolio Management CFA Level 1, the Portfolio Risk and Return Part 1 and Portfolio Risk and Return Part 2. Now these two readings are given as a separate reading in the curriculum, but in my opinion, if you prepare these two readings in a combined structured form, it will improve your understanding, and that's why we will revise these two readings in this combined format. Now one more note before we begin our revision. In our curriculum, the discussion goes like we have the concept and then we have the numerical part, then we have the concept, then we have the numerical part, and all these concepts are somewhere stitched and not stitched. What we will do here, we will first discuss all the numerical part instead of discussing the theoretical part or the background, theoretical foundational background of the numerical concept. Numerical concepts are easy to understand. If you get a question on the numerical area, it should be based on like the pure numerical side and not on the foundational side. So that's why I'm separating the discussion. First, the numerical discussion related to all the concepts which are given in the curriculum in these two chapters, and then we will see the foundational theory. Also, there is one more reason like why we are discussing it like this. If there is a theoretical question on these two chapters, ideally, in my opinion, it should be designed like comparing one foundational theory with the another foundational theory, and not the foundational theory of one and the numerical theory of another, right? So that's why we should discuss the foundational theory simultaneously so that we are able to compare what is the difference between the multiple foundational theories. Okay, that's why whole foundational part in one go, and this we will do in the end. So if you see the slides are like the first the basic concept, then we have the risk and returns concept, then we have the multi-factor, single factor, and that is a CAPM equation. Okay, then we have the foundational theories in the last two slides. So total 5 slides for the revision. This should be like good for your preparation and the revision part also. Make sure you watch these videos multiple times, and if you like this video, just comment me on this video so that I get the motivation to upload all the other revisions also. Fine. Okay, so that's all. Now we'll start the revision part. Okay, now let's see the first slide. In the first slide, we will discuss the basic concepts given in both the chapters, the part 1 and the part 2. It starts with the characteristics of the asset classes, very brief discussion or the introduction. First is like understand the risk and return trade-off. It is simple, like the higher return will come with the higher risk, or if you take the higher risk, you will produce the higher return. And then we have the related historical observations for this. So small cap stocks, we know the small cap stocks are the high risk stocks, produce the highest returns and the standard deviation. Remember, this is based on the historical data. And the T-bills, which is the safest instrument to invest, produce the lowest returns and with the lowest standard deviation. Again, as I said, this is based on the historical data. Next concept is about the real return. So real return is equal to the nominal return minus the inflation. You can restructure this particular equation into the nominal return is equal to the inflation or the expected inflation plus real return. So let's say if the bank offers you 7% return on say fixed deposit of the CDs, so this 7% offered to you is the nominal return and not the real return. So this 7% is the nominal return plus, let's say in this period the inflation is 6%. Inflation is the 6%. So your real return is equal to 1%. So this is what you need to remember here. Nominal return is equal to inflation plus risk-free return, or you can also remember the reverse equation. That is real return is equal to nominal return offered by the bank. Whenever you see the risk-free rate, remember you're talking about, or that risk-free rate is about the nominal return, and minus the inflation will give you the real return. It is not necessary that to have the real return may be 0 also. Approximate real returns based on again the same 1926 to 2017 data. The T-bills produce the real return of 0.5% approximately, and US large cap stocks produce the real return of 7.3% approximately. Again, you don't, in my opinion, it is not necessary to remember these values, but okay, you need to understand the T-bills produce the lower real return compared to the large cap stocks. This much is, or this should be enough. Then the return distribution characteristics. Now we're discussing the quants that the return should follow a distribution, or returns follow the distribution. These are assumption. So we generally follow the returns of any asset or the equity or stocks follow the normal distribution based on which we do the further analysis, because for the hypothesis testing this is required. You need the normal distribution assumption for a lot of tests. But the observation based on the historical data is the asset returns in general are negatively skewed. Remember this, and exhibit the fat tail problem. That is, the kurtosis is greater than 3. Now here I'm assuming you are good with the quants concept. So if you are good with the distribution, skewness, kurtosis and so on, then this is like the self-explanatory part. Again, remember these points. Liquidity problems. The low liquidity can lead to pricing discounts. Obviously, simply means like if the asset is lowly liquid, or sorry, the asset is illiquid or exhibits the low liquidity, then that asset should be priced lower compared to same characteristic asset but which has the higher liquidity. So you have say asset A, asset B. Asset B has the same characteristics except for the asset A has the lower liquidity, asset B has the higher liquidity. Then asset A should be priced at a lower price and asset B will have the higher price because of the liquidity discount. And ultimately, because of the illiquidity, your required rate of return will increase. Because your required rate of return increases, ultimately it will impact the prices. That's why the word pricing discounts and increased expected returns or required rate of return. Okay, remember. Here, the required rate of return and expected return are replaceable words in this particular context. Now, the common in emerging markets and infrequently traded securities. This particular observation is common in the. These observations are common in the emerging market and the infrequently traded securities. Fine. Yeah. One more thing. Before we again proceed with the further discussion, here you have the brief history of the modern portfolio theory or the portfolio management theories development. Now, once you understand this particular development, we just understand it. It is not the part of your curriculum. This is from my side. You don't have to remember anything. Also, like I mentioned here, it is not relevant for your exam. Okay, so but understanding it will help you in understanding why all the concepts in these two chapters look similar but are not similar concepts. Okay, why one particular like the capital allocation line and securities market line behave in a certain manner. Okay, so let's see what happened. Quickly, I'll discuss this. Ideally, I should have started with this particular discussion, but I forgot to mention it. Now, in 1952, the Harry Markowitz gave the modern portfolio theory (MPT). This MPT discusses the plain and simple mean variance optimization framework where the concept of diversification to reduce the risk is introduced. That's it. Nothing happened, nothing extra happened at this particular point. Then in the 1956, the diversification risk, Gordon increased or developed on the fundamental mean variance framework theory. It stressed that the investors diversify to reduce the firm specific risk, and this is the source of systematic and the unsystematic risk concept. Then we have the separation theorem, two fund separation theorem. James Tobin combined the risk-free asset with the risky asset. That's why you will see in some theories, we are not talking about the risk-free asset, and suddenly we see in the capital allocation line, there is a risk-free asset introduction. This is the reason why we have risk-free assets introduction in the capital allocation line and not in the previous discussions, because in the previous theories, there was no risk-free asset introduction based on their own fundamental theories. So here Tobin gave us the combined risk-free asset with the risky asset. This is what you can do. And this will ultimately give you the capital allocation line. Then we have the CAPM model, capital asset pricing model, given by the Sharp, Linton, and the Mersin. All three mathematicians, these three mathematicians developed the CAPM equation independently. It is not a joint development. Everyone came up with the same conclusion using the different mathematical proofs. That's why all three gets the credit, but it happened in the same year or in similar time frame. It linked the expected return or required rate of return of the security to its systematic risk beta, that is undiversifiable risk, and then it introduced the securities market line. Then we have the Sharp ratio, Trainer ratio, and Jensen's alpha, given by the William Sharp, Jack Trainer, and Jensen. Now, Sharp introduces the excess return per unit of the total risk. Trainer introduces the excess return per unit cost per unit of the systematic risk. And the alpha is based on the CAPM to assess the fund manager's performance. Remember, this is to assess the fund manager's performance. And then we have the M square, Modigliani and Modigliani. Remember this Modigliani and Modigliani is the granddaughter, grandfather duo, Franco and Lem Modigliani. They gave us the Sharpe ratio. We also have the Modigliani related theories in the, I guess it is in the CFA level 2 in the equity section. Okay, and the percentage return for the better comparison with the benchmarks. Okay. Now let's see the, just understand like these are different theories. Again, I'm repeating this again, like you don't have to remember anything related to this particular historical data for your exam. This is my addition to this particular chapter. Now, what is the concept of risk aversion? Very simple. The risk aversion, or simply the risk averse investor, will prefer the lower risk. Very obvious, but the key point here is the for the same expected return. This is very important. If you get a question in the examination which simply says that the risk averse investor prefers the lower risk, the statement is wrong. Risk averse investor prefers the lower risk for the same expected return. So if you offer a risk averse investor, let's say two assets A and B, and let's say the return and the standard deviation both offers 10% return, and one offers 5% standard deviation and another offers 6% standard deviation, then you can apply this risk aversion theory and say, okay, he will prefer the asset A because it offers a lower standard deviation for the same level of expected return. But if you change this particular example into, let's say it is 10% and 12%, then you can't confirm about the risk aversion part, because remember the statement is same expected return. Okay. Now it assumed all the standard financial, it is assumed in the all standard financial model. So in general, this is the fundamental assumption that all the investors are risk averse. Portfolio selection implications, how this particular risk aversion impacts the portfolio selection. If the expected returns are equal, in the portfolio, risk averse investor will choose the portfolio with the lower standard deviation, and higher risk perform portfolios are chosen only if the higher expected return compensate for the additional risk. How much compensation should be there is not the part of our discussion. Just remember, you have to understand, for the higher risk, to motivate that risk averse investor to take the additional risk, you have to offer the higher returns. Now the types of investor, risk averse investor, you understand, risk neutral and risk seeking. Again, remember, in all these cases, the assumption is given the same expected return. So risk averse investor will choose the lower risk options. Risk neutral investor will choose the he will be indifferent. It doesn't matter for him. He can choose A or B. Okay. And risk seeking investor will choose or prefer the high risk options. We don't assume this particular, like the risk seeking investor in general in any financial fundamental theories. Now the concept of systematic versus the unsystematic risk. Easy to understand. But remember, the systematic and unsystematic risk is introduced in very later part. After in the fourth theory it is introduced. But because it is easy to understand in the introduction level, that's why we are discussing it here only. The total risk, that is a sigma. Whenever you calculate the standard deviation of the portfolio, it is the total risk. This total risk can be broken down into the systematic risk and unsystematic risk. We don't have the mathematical calculations in our curriculum. We don't have this calculation like how to split the sigma into the systematic part and the unsystematic part. So that's why we will stick to the theoretical understanding only. So the standard deviation can be divided into the two parts: the systematic risk, which is measured using the beta, and then we have the unsystematic risk. Unsystematic risk is the firm specific risk, also known as the idiosyncratic risk. Remember this. If you get this word, idiosyncratic risk. The idiosyncratic risk is unsystematic risk, which is the diversifiable risk, is the firm specific risk. This is the firm specific unique risk, which is unique to particular company. This can be eliminated via diversification. So if you have the enough diversification in your portfolio, you will be able to eliminate the unsystematic risk or the diversifiable risk. Because this is diversifiable risk, you won't get any compensation or additional return for it in the expected return for bearing it. But you will see, like, okay, in our observation, we have seen like the risky firms offer more returns. The reason for it is, understand, when we are discussing anything in the finance, it is in the context of that particular theory. So it is completely possible that in some cases, the historical observation is the lower risk asset produce the higher returns compared to higher risk assets. It is possible. But when we are discussing any theory, in that theory, we have to understand everything in that theory's context. Okay. Now, next is the systematic risk, which is a non-diversifiable risk. Non-diversifiable risk is the market-related risk which cannot be diversified. If the market goes down, every company will go down. So you can't diversify it. Even if you have the full portfolio, well diversified portfolio, you will get impacted by the systematic risk, and hence you will get compensated for it. So your required rate of return will be higher because of the systematic risk. So cannot be diversified away. Only risk that is awarded with the higher expected return. The key implications are investors should hold the diversified portfolio. What happens if you don't hold the diversified portfolio? Remember, if you hold only one asset, you are not getting any additional compensation for holding that unsystematic risk component. So it will create a problem for you or losses for you. That's why hold the diversified portfolio. Expected return depend only on the systematic risk measured by the beta. Again, we will discuss it later. Holding many stocks, example 30, eliminates most of the unsystematic risk. Again, this is not a perfect diversification. Broad understanding, but not a perfect diversification. This how to diversify it in a perfect manner is given by the mean variance framework for the optimal portfolio diversification, or the creating the optimal portfolio. Okay. Next discussion, the next slide is about the risk and returns of the two asset portfolio. Now this starts with the single asset risk and returns. So we know, like, we can get the data on the returns of a particular stock. So you have the single asset risk and return, single asset returns. So you can calculate the arithmetic average of those returns. So you will get the mean return. Now you have the mean return. We will call this as, let's say, RA, the return of the asset A, or the average return of the asset A. Then we can calculate this standard deviation using this particular formula, that is under root of summation x minus x bar square divided by n minus 1. If you are assuming the sample standard deviation, you don't have to remember this particular formula. You can solve this using the calculator. Financial calculator provides this feature where you can feed the data and get the answer. So if you get a question on this particular part, you don't have to bother about the formula. Learn how to feed the data and get the answer. And remember which one is the sample standard deviation and which one is the population standard deviation. This should be sufficient. Now, this is what we did to the asset A. Same thing we can do for the asset B also, right? For the asset B. So for asset A, you have the return and the standard deviation. For asset B, you have the return and the standard deviation. Once you have the return and the standard deviation, you can move on to the two asset risk return concept. Now remember one thing. In real life, you will be dealing with the multiple assets return and the risks. But in the academic setting, because it is not practically possible to test the risk and return calculation for multiple assets, they limit to 2 or 3 assets portfolio. This does not mean that we know only about the two asset portfolio and we don't know how to deal with the multi-asset portfolio. Same logic will be applicable for the multi-asset portfolio, but in academics, it is not possible to test the question on multi-asset portfolio. That's why we have only 2 assets. Remember this, okay? Now, you have the return and the risk calculated individually for the each assets, RA and RB. It is here, it is mentioned as a 1 and 2. My flow of saying is the A and B, or 1 and 2 is also fine, okay? Now, the return of a 2 asset portfolio is calculated as the weighted average of the means. Simple. Okay, so if you have, say, 60% invested in the first asset and 40% invested in the second asset, then you have the risk also. Let's say the standard deviation of the asset 2 is equal to 12%. Standard deviation of the return of the asset is 12% and the return of asset 1 is, say, 10%. You can simply calculate the return of the portfolio simply doing the weighted average. Now, for the risk part, remember, we are applying same formula, but this same formula then gets developed into this particular formula. And here the logic is the correlation of 1 and 2. The correlation of A and B, asset A and asset B's correlation should be incorporated into this particular formula. And that's why we have this formula. Otherwise, we would have gone with this same situation. Now let's see. What if this particular correlation between the two assets is perfectly positive correlation? Perfectly positive correlation is the +1 correlation, right? If you put the +1 correlation, this whole formula becomes the A square plus B square plus 2AB. Now from the school level mathematics, we know what is the final solution for this. This will be A plus B square. Remember, A is this particular term, W1 sigma 1, and B is W2 sigma 2. You square it, you under root it simultaneously, you simply get the sigma of the portfolio is equal to A plus B, that is sigma 1 W1 plus sigma 2 W2, like this. Got it? Fine. Now see here, when there is a perfect positive correlation, you get this. But the correlation between the two assets, when it is less than a perfect positive correlation, it provides us the diversification benefit. Now remember, when you have the correlation, which is perfect positive correlation +1 correlation, you will get the highest standard deviation for the portfolio because of this weighted average. And when you start lowering this correlation from the +1 to, let's say, 0.8, 0.7, 0.2, 0, -0.2, -0.4, and so on till -1, your diversification will increase, the diversification benefit will increase, and this diversification or the increase in the diversification benefit will ultimately result into the lower standard deviation of the portfolio, to asset portfolio. Okay, so how to remember this particular formula? This particular formula, the standard deviation formula, not this one, yeah, this one. So it is simple, just understand or remember the rhythm, the sigma 1 W1 square plus sigma 2 W2 square plus 2 into sigma 1 sigma 2 W1 W2 correlation of 1 2. Either remember it like this or simply do the basic A plus B square mathematics, okay, and simply add the correlation term in the end and then solve it and you will get the answer. Remember, the answer is standard deviation of the portfolio. Okay, I'll repeat this again and you can repeat this multiple times and you will be able to remember it. I also remember the 3 asset portfolio formula. I repeated it multiple times and then it became a rhythm. Okay, so sigma 1 W1 square plus sigma 2 W2 square plus 2 into sigma 1 sigma 2 W1 W2 correlation of 1 2. If you have the 3 asset portfolio, then you can use this particular formula. The sigma of the portfolio is equal to under root. I forgot to mention the under root, it is visible here. Okay, so under root sigma 1 W1 square plus sigma 2 W2 square plus sigma 3 W2 3 square plus 2 into sigma 1 sigma 2 W1 W2 correlation of 1 2 plus sigma 1 sigma 3 W1 W3 correlation of 1 3 plus sigma 2 sigma 3 W2 W3 correlation of 2 3, like this. Okay, repeat this and you will be able to remember it. Fine. Remember, now if there is a case 1 perfect positive correlation case, there is no diversification benefit. The risk is simply additive. This again, the risk becomes, the risk of the portfolio is simply the weighted average weighted average of the risk of the individual asset. What if you have the zero correlation? If you have the zero correlation, this whole term will become 0. Now you are left with these two particular terms and that's it. Okay, the sigma of the portfolio, when you have the correlation between the two assets is equal to 0, you get this particular formula. So remember, you have to remember this particular formula and based on this you can deduce the remaining formulas. If you have the perfect negative correlation, then this particular term will become -1. The correlation becomes a -1. That's why this will become, instead of plus, this will be minus. Now you have the formula of A square plus B square minus 2AB. This gives us the A minus B square. And ultimately you will get this particular part, that is sigma P is equal to sigma 1 W1 minus sigma 2 W2. Perfect negative correlation. Okay, this gives us the maximum diversification possible. Okay, this is the best or the highest diversification which is possible. Now what if one of the asset, sigma asset A and asset B, if one of the asset is a risk-free asset, in this particular case the sigma of the one asset which is a risk-free asset will be 0, because for the risk-free asset the definition of the risk free is ultimately the standard deviation is equal to 0. If the standard deviation is equal to 0, in that particular case, this will be 0 and this will be 0. If we assume the 2 is the risk free asset, you will be left with under root of sigma 1 w1 square, right? And simply you will get the standard deviation of the portfolio is equal to w1 sigma 1 or sigma 1 w1. Okay, so you have to remember these formulas. You should be able to simply plug the values. Okay, here you also have the illustration. Yeah, so this is the illustration. Weightage are given, expected return are given, and the standard deviation is given for the two assets, and based on this you can calculate the expected return and the standard deviation. That's it. Okay, very simple. And you have to calculate the standard deviation under the following scenarios so that you are able to reconcile what we discussed here. Next concept is related to the beta. Beta is the measure of the systematic risk. Now remember, the sigma of the portfolio is the measure of the total risk. But if you have the well-diversified portfolio, you are concerned about the beta only, then you have to calculate the beta. Remember, the beta is the measure of asset sensitivity to the market movements. Understand the difference between the correlation and the beta. Correlation only talks about what is or how the two asset moves in the positive direction or in the negative direction or in the strongly positive direction. For example, if the asset A increases, the price of the asset A increases 10 times, then asset B will also increase 10 times, right? Like this. This is the correlation. But correlation doesn't answer if the asset A increases by 10%, what will be the increase in the asset B? It is not given by the correlation. Correlation doesn't talk about this. Beta gives you this particular answer. Beta tells if the asset A increases by 10%, then if the beta is say 0.5, if the beta is 0.5, then the asset B will increase by 5%. Now here, in this particular context, the beta is a measure of sensitivity to the market movement. So if the beta of this particular security A is say 1.5, if the market increases by 10%, then the assets return will increase by 15%. 10% multiplied by 1.5, 15%. Like this. Fine. Now it represents the systematic risk you are taking relative to the market. The market's beta is equal to 1. So if a particular asset's beta is equal to 1, this means you are taking risk equal to market. If the beta is less than 1, you are taking less risk compared to the market. If the beta is more than 1, let's say 1.5, then you are taking more risk compared to the market. And if you take the more risk, ultimately you will get the more return or the expected return. If you take the less risk, then you should get the lesser return compared to the market. And this is given by the CAPM, capital asset pricing model, which we will discuss later. Right now, just focus on the beta concept. What is the formula for the beta? The beta's formula, there are two formulas. The beta is equal to the covariance between the A and B. Here B is the market, or simply A and M, the asset and the market, the covariance between the return of the asset and return of the market divided by variance of the market. Sigma M square is given here. Okay, so sigma M square in the denominator and covariance of A and M in the numerator. Simply solve it and you will get the beta. Alternate formula is this is the same formula, okay, written from the different perspective. The beta is equal to correlation between the I and M, sigma I and sigma M, like this, okay. Correlation between this I, M, I here is again the A, asset A, and M is the market, okay. Fine. Okay, again, I'm not providing the link between the formula, how these formulas are derived. Just recall the formula of covariance. What is the formula for the covariance? If you restructure the formula for the covariance is equal to, the same logic will be applicable here also, okay. The formula for the covariance is sigma 1 W1, sigma 1 sigma 2 and the correlation of 1 2. This is the formula of the covariance. Covariance is equal to sigma 1 sigma 2 correlation of 1 2. Here also you can replace this whole term, that is sigma 1 sigma 2 correlation of 1 2 with the covariance of 1 2, okay. And if you replace this here, replace this particular part, then that sigma sigma will get cancelled and correlation of 1 2 and the sigma 1 will be left, and that's how you get this particular formula. Okay, you can do it by for yourself, or otherwise like simply remember the formula. Remembering these formulas is very very important, and remember what's in the denominator, the difference between the denominator of like the different formulas. If you are using the covariance, then you have to use the variance in the denominator, variance of the market in the denominator. If you are using the correlation root for the beta calculation, then you have to use the only sigma, standard deviation of the market, not the variance. And in exam also focus on what is the information given. If the variance is given, then you have to take the under root to get the standard deviation. Don't use the variance directly in the formula by mistake. Okay, now here the correlation of the asset, the correlation I is equal to correlation of the asset I with the market. Then this is the standard deviation. Again, we already discussed what are the terms here. Okay, and the beta is estimated via linear regression of the assets excess return on the market excess return. Just remember, this is simply the linear regression part. In the one variable regression, we discussed the formula y is equal to a plus b x. That b is the beta. This also gives us the slope of the regression line. Okay, the beta security characteristics line. This is where we will discuss it. Now the beta is equal to market means the asset moves in line with the market, so you will get the return is equal to market. If the beta is greater than 1, then you will get the more return than the market, and because it is more volatile than the market. If it is less than 1, you will get the less, it is less volatile compared to the market, and you will get the less return. If it is below 0, then asset moves in the opposite direction. Now, this is about the beta calculation. This was also the fundamental concept, the basic concept. Then we have the capital asset pricing model, and then we have the applications of all these theories in the performance measurement. Okay, this particular domain is related to the performance measurement. The performance measurement can be for the portfolio or for the manager. So let's see what's the Sharpe's portfolio, Sharpe's ratio. Sharpe's ratio. Sharpe's ratio. Sharpe's ratio's formula is the return of the portfolio or expected return of the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. RP minus RF divided by sigma P. It measures the excess return per unit of the total risk taken, and this is based on the standard deviation. Now, the key point to remember here, it is useful for both the diversified and concentrated portfolio. That means the undiversified portfolio. It can be used in both the situations. Higher the Sharpe, better the risk adjusted performance. So if you are provided with this situation, let's say this portfolio A, B and C, and portfolio A provides highest Sharpe's ratio, so that portfolio is the most desirable portfolio because it offers the more return per unit of risk. And remember, this is because you are using the standard deviation in the denominator. This is also suitable for the individual securities, undiversified portfolios, and also for the diversified portfolio. But for the diversified portfolio, better measure is the trainer's measure. Trainer's measure measures the excess return per unit of the systematic risk. Now, systematic risk is applicable only when you have eliminated the unsystematic risk. That's why trainer's measure is suitable only for the well-diversified portfolio. Trainer's measure should not be used for the individual securities or the undiversified portfolios. The formula for the trainer's measure is similar to the Sharpe's measure, RP minus RF, but in the denominator we are using the beta of the portfolio. Okay, simple. Then we have the Jensen's alpha. Jensen's alpha takes the support of the CAPM equation. I assume because you have already prepared the CAPM like read once in the curriculum. So the CAPM equation is known for you. So Jensen's alpha is the alpha, in simple terms, is how much return is produced compared to what was required by you. So CAPM gave us the required rate of return, the expected rate of return, and return of the portfolio is this. So alpha is simply the extra return produced over what was required or expected. It measures the excess return above the CAPM's predicted return. The positive alpha means the outperformance on a risk adjusted basis. Again, you don't have to remember the full term here. RP minus CAPM return. Remember this. RP minus CAPM return. And for CAPM return, you will anyway remember the formula. That is RF plus beta into RM minus RF. Right? And we will discuss it. Now, the M square measure, Modigliani and Modigliani measure, converts the Sharpe ratio into the percentile form. The Sharpe's ratio is multiplied by the sigma m plus the risk-free rate. Sharpe ratio multiplied by the sigma m, sigma of the market, plus you will add the risk-free return in it. It converts the Sharpes into the percentage return, compares the adjusted portfolio return to the market. And then you can also have the M square alpha. M square alpha simply is this here M square minus the return of the market. M square minus RM. So remember these formulas again. If you are able to remember the formula, it is simply the plug and play. Okay, you have the information, use that information in your equation or the formula, and you'll be able to solve it. That's why we are not discussing the calculation part here. Okay, now let's see the third slide. In the third slide, we have the CAPM, the capital asset pricing model, very important model for the real life as well as for the exam. The capital asset pricing model equation gives us the required rate of return or the expected rate of return. Remember, I am replacing these words, required rate of return and the expected rate of return, because these words are used replaceably. Okay, you can, in the academic books also, these words are used alternatively. So here, expected rate of return is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. Let's understand the first term here. The RM minus RF is the market risk premium. Market risk premium. That is the return market produced above the risk-free rate. In alternate words, how much you are earning extra by choosing to invest in the market portfolio than instead of investing in the risk-free rate or the risk-free securities. So you have choices, right? So you can invest in the risk-free security, and let's say risk-free security is offering 6% and the market is offering 15%. So the market risk premium, the premium you are earning by investing in the market is 15 minus 6 here, which is 9%. So 9% is your market risk premium. So remember the differentiation. Market return is the expected return of market, that is ERM is the expected return on the market. RM minus RF is the market risk premium. Okay, so some students may make mistake in this particular part. Let's say you are provided with the market risk premium of 12% and the risk-free rate of 7%. So you may end up taking like this, 12 minus 7%. You will make mistake. This 12% is already the solved answer of RM minus RF. Then you multiply it with the beta, and then you add the RF. Okay, simple. RF is the risk-free rate. Fine. Now, if the beta is equal to 1, this CAPM equation gives us the explanation why your expected rate of return should be equal to the market return. So for this, we will assume the RF is equal to 5%. This is 10%, and this is again 5% because RF is 5%. Now, if your risk is equal to the market, your systematic risk is equal to the market risk, that is 1, beta is equal to 1 here. In this particular case, we all understand you should get the return equal to the market. If you solve this equation, your final answer, that is 15 minus 5% is equal to 10%, 10% multiplied by 1, 10% plus 1, 15%. So your final answer is 15%. See, this equation also shows us if you are taking risk equal to the market, your expected return should also be equal to the market. If the beta is equal to 2, then you should get the extra return compared to the market. How much it should be? Just see, 15 minus 5% is equal to 10%, 10% multiplied by 2 is equal to 20%, 20% plus 5% is equal to 25%. So this is 25%. Now understand the difference. Just because you are taking the double risk, your return is not going to get doubled. You are taking double risk compared to the market. Market's return, expected return is 15%. You are taking twice the risk of the market. So you should not get the 30% return, because remember, your return is based on, the extra return is based on the extra risk taken by investing in the market. So how much is the extra risk you are taking? That is a market risk premium, 15 minus 5%. 10% is the extra risk taken. That's why you are getting only 10% multiplied by 2 extra. Okay, fine. I hope you are able to understand this. Just understand the formula and this should be sufficient for your exam, and understand like lowering the beta will lower the ER and increasing the beta will increase the ER. Now, what are the assumptions used in the CAPM model? Super important. The investors are risk averse. As we discussed in the beginning, this is the common assumption used in all the financial models. And utility maximizing. Frictionless market. Remember the term frictionless market means no taxes or the transaction cost. No taxes on the transaction cost. Keyword is no transaction and the taxes. If you get a question which says the frictionless market means the constant taxes and the transaction, this is not the correct. Okay, this is not the assumption. Assumption is no, absolutely no taxes and the transaction cost. It includes the commission also. Homogeneous expectation, all the investors have the same expectations. One period time horizon, you are assuming the single period time horizon, okay? And the assets are infinitely divisible. So if you want to invest in 0.5 shares, you will be able to invest in it. In real life, you won't be able to, but in the theory, this should be allowed, because remember the mathematical, this CAPM is the mathematical theory. The mathematical theories and their assumptions are written to ensure that the model does not violate the fundamentals. In practical life, you have to make the adjustments. For example, here you assume no taxes and the transaction cost, because to make sure this equation works properly, this assumption should be there. But in real life, you will separately adjust the taxes and the transaction cost part. Okay. And the perfect computation, prices are taken as given. Okay, these are the assumptions. You have to remember these assumptions. Once you have the CAPM equation, using the CAPM equation, you get two lines. First is the security characteristics line. This gives the characteristic of the security. On the y-axis, you have the assets excess return. I'll zoom this again. On the y-axis, you have the assets excess return, that is RM minus RF. Remember, our equation is not RM minus RF. RP minus RF, or simply the ER minus RF. ER minus RF is on the y-axis. On the x-axis, it is RM minus RF. Okay. And what is our equation? CAPM equation. CAPM's equation is RP is equal to, I'm writing it as RP to simplify the writing. So RF plus beta into RM minus RF. So what we did here, we simply like changed from RHS to LHS. So RP minus RF is equal to beta into RM minus RF. So what is the meaning of the security characteristics line? So security characteristics line tells us if you increase the market excess return, your asset excess return will increase with the slope of beta. Here the slope is beta. So if the beta is higher, then your asset excess return will be higher. Ultimately, let's say here you have 5% versus 10%. So if you have the 5% multiplied by beta, then your RFP minus RF will be higher. If you take it 10%, it will be more higher, right? And beta, let's say assume it is 1.5%. So higher the slope, higher the asset excess return. And then we have the capital asset pricing model, CAPM's line. Remember, this line was the security characteristics line, which is based on the restructuring of the CAPM equation. Here on the x-axis, we have the market excess return. On the y-axis, we have the asset excess return. That is ERP minus RF. And here you have the RM minus RF. In this capital asset pricing model, you have the impact of beta. Higher the beta, higher the ERI. Higher the beta, higher the expected return. Simple. Okay. At beta is equal to 1, you will get the expected return equal to the market. If you increase the beta, this will increase. If you lower the beta, you may reach to the RF. Here the RF point is also important. If your beta is 0, then you will get the return equal to the market. And this is the securities market line. Remember, one is the security characteristics line, which is by adjusting the CAPM equation. This is the other line is the securities market line. this is by using the CAPM model, capitalistic pricing model. Fine. And you have to remember what is on the x-axis and the y-axis for both the lines. What is the difference between both the lines? Okay, fine. Next is the multi-factor model. Now the multi-factor model, here you have to understand the basic features of the model. Multi-factor model is simply the model multi-factor model. The first is the basic multi-factor model, general multi-factor model. It simply says in the CAPM you are using only one factor. So it says you can use the multiple factors. That's it. Now what are these factors? This general multi-factor model does not specify the factors. It is simply saying you can use the multiple factors. That's it. The beta 1 factor 1, beta 2 factor 2, beta 3 factor 3, and so on. Now this multi-factor model is used by the other mathematicians, and then they added the specific factors. So first we have is, and types of factors which can be used are, in the macroeconomic factor you can use the GDP, inflation, interest rate, fundamental factors like the size, value, and the earnings growth, and the statistical factors like the data driven can be there. The Fama, French, and Carhart model uses the market excess return, size, small minus big, and the value, high minus low book to market value. This is the model. This much is important. Okay, intentionally the full model is not provided here. It will unnecessarily complicate the discussion. You have to just understand what is covered in the Fama French model. Okay, now this particular part is from the Fama and French. But when it says the Fama, French, and Carhart model, the Fama, French, and Carhart model is the four-factor model. And the fourth factor is the momentum. Fourth factor added in the Carhart model is the momentum. If you have the question on the Fama and French, only three factors. In the Carhart, that is Fama, French, Carhart model, there are four factors. Three factors are the same. Fourth factor is momentum. This is what you have to remember. Then the market models. Based on the statistical estimation, you can use the CAPM model. The actual return on the asset, the actual market return, intercept, beta sensitivity, and the abnormal idiosyncratic part. This is the idiosyncratic part or the abnormal part. Okay, error term. This is same as our one variable regression. Uses of this particular basic model is estimate the expected return and the abnormal return. The same model can be also used to measure the error term. It measures the systematic risk also. We discussed in the CAPM where we know like the beta is calculated using, or beta can be calculated using the statistical model. So this is the same your one variable linear equation. What you need to understand here, nothing, like just know there is market model is there. Okay, for the statistical estimation, which is same as the one variable regression. Again, I'll just repeat this. There was general model, no factors were mentioned. Fama, French, and Carhart included or specified what can be the factor 1, what can be the factor 2, what can be the factor 3, what can be the factor 4. And then we got the Fama, French, and Carhart model. There are multiple models like this. Right now, for you in the level 1, this much is enough. Rest of the models we will discuss in the level 2. Okay. Then we have the illustration based on whatever we discussed in the previous slide. Okay. This particular illustration was related to this particular part, and because there was not enough space, that's why I avoided this discussion, like included this particular illustration here instead of in the top. Then we have the fundamental or the foundational theories. In the foundational theories, if you read the foundational theory, it is big chunk in real life. For exam purpose, know the key terminologies. What is the term? That's it. Because learning objectives are designed like this. What is the investor's utility function? It represents the trade-off between the risk and the expected return. In simple terms, how much risk will be taken by the investor for the given risk return. Higher utility means higher preferences. Indifference curve. Indifference curve shows the combination of the risk and the return for which an investor is equally satisfied. Investor is equally satisfied. On the graph, you must have seen this particular graph, the indifference curve graph. So let's say this is the indifference curve 1. On this indifference curve, the investor gets the same level of satisfaction in all 3 points. If you move higher, then you get the indifference curve 2. Again, on the indifference curve 2, all the points represents the equal utility or the equal satisfaction. This is what you need to remember. These are sloping upwards because as the risk increases, here you have the risk and here you have the return. So as the risk increases, the risk aversion, remember, our fundamental assumption is investor is risk averse. So if he has to take the more risk, he will ask for the more return. And the steeper curve means more risk averse. If you compare the investor on the IC1 compared to the investor on the IC2, the IC2 investors are more risk averse compared to the IC1. More upward curves is equal to higher utilities. Here it is higher utility, lower utility. Then we have the capital allocation line. Now capital allocation line shows the combination of the risk-free asset and the risky portfolios. I will explain capital allocation line, which is given here. Okay, here you have the capital allocation, capital market line, and the capital allocation line is here. Okay, we will discuss it. Then we also have the two-fund separation theorem. You have to understand what is the two-fund separation theorem. In the optimal risky portfolio, the same optimal risky portfolio, you can include the risk-free asset. This is the two-fund separation theorem. It assumes the optimal risky portfolio plus risk-free asset. It is based on the risk tolerance, and the optimal portfolio lies on the tangency point of the capital allocation line and the investor's indifference curves. Again, we will see it later. Now, the portfolio choices are based on the risk aversion. More risk averse investor will choose the portfolio with the lower standard deviation, more weight in the risk-free asset. We will put more weight if the investor is more risk averse, more weight will go into the risk-free asset and lower weight to the portfolio. Less risk averse will put the more weight to the portfolio, less weight to the risk-free asset. Again, now understand this. You have the optimal portfolio theory, mean variance framework, and so on. There are multiple theories. Now, if we try to knit these theories together, like how one theory is linked with the another and then whole process is there, this whole process requires a lot of time to explain, and our objective is to revise the whole chapter from the exam perspective. That's why I'm outrightly ignoring the fundamental explanation part. For example, I simply told you what is the indifference curve, what is this capital allocation line, what is two-fund separation theorem, and so on. Now, ideally, if you assume like this is a regular class, I should be knitting or stitching these 2 or 3 multiple, like the concepts given here, together, how one is related to the another. But in my opinion, this will extend the discussion, not also relevant for the question part. Okay, that's why we are ignoring it. And this is just my assumption. Okay, it is not relevant for the question part. Now let's see the mean variance framework. Mean variance framework talks about the minimum variance portfolio. Here again, in the mean variance framework, we are seeing the multiple terms. Now, what is a minimum variance portfolios? Minimum variance portfolio is the portfolio with the lowest standard deviation for the given level of expected return. Simple. If you see this particular chart or the graph, here all these dots represents the possible portfolios which you can create using the available market assets. Whenever you see any portfolio which offers the lower standard deviation for the same level of risk, remember this, lower standard deviation for same level of risk, we will call them as the minimum variance portfolios, MVPs. So if you consider these points, so this particular portfolio is a minimum variance portfolio. If you consider these points, then this particular portfolio, this particular portfolio is the minimum variance portfolios. All are the minimum variance portfolios. All, remember, all are minimum variance portfolios, and anything beyond this are not the minimum variance portfolios. Okay. Minimum variance frontier, this whole part is the frontier. Okay. Minimum variance frontier. Remember, this is minimum variance frontier, not efficient frontier. Set of all MVPs across the different expected return levels includes both the efficient and the inefficient portfolios. Now, what is the efficient frontier? The upper portion of this minimum variance frontier gives you the efficient frontier. This is this particular part. Only this particular part is the efficient frontier. Why? Now understand this. If I give you the choices again, like easily understandable, if I give you the choices between these three portfolios in the vertical line, obviously any investor will invest in this particular portfolio, They won't be interested in this particular portfolio because our assumption is all the investors are risk averse. So for same level of standard deviation, investor will always choose higher expected return. So in similar logic, all these returns are all these portfolios are preferable. If you check this particular structure, the portfolios, all three offer same expected return. So investor will choose this instead of this because for the same expected return, this one offers the more or gives the has the higher standard deviation, and this one has the lower standard deviation. So every investor will choose the higher standard deviation, lower standard deviation. Now understand this. If you compare this particular portfolio and this particular portfolio, so in this particular part, it is always this one, the A is investable. You can relate or compare all such portfolios. This means when they invest, the assumption is investor is rational. So any rational investor will always choose or invest in this particular region, and this particular region is not investable because you always have the better portfolio available which provides the more expected return, right? So that's how we get the efficient frontier. Now, the efficient frontier is the upper portion of the minimum variance portfolio. Minimum variance frontier, sorry, not portfolio. And it represents the portfolio with the highest expected return for each level of the risk preferred by the risk averse investor. And it is the area above the global minimum variance frontier, GMVP, global minimum variance portfolio. The portfolio which offers the lowest variance among all the portfolios. This is the global minimum variance portfolio. Okay. The lowest possible risk offered among all the portfolios. This is the leftmost point on the minimum variance frontier. Now, you have this particular structure. Here you have the risk-free asset and you have the efficient frontier. When you start combining any of the portfolio, let's say this portfolio or your hypothetical portfolio, this particular portfolio, or this particular portfolio which we call this as the tangency portfolio, market portfolio. When you have this situation, the investor will start combining the risk-free asset and the risky assets. Risky asset as in these three portfolios and risk-free asset as in this. Okay. So if you invest 100% in the risk-free asset, then you will get this particular point. If you increase the weight of risky asset, then you will land in this particular point. Here, remember, here we have the standard deviation. On the x-axis, we have the standard deviation. Here we have the expected return. So you keep increasing the weights and you will reach to this particular point where you are 100% invested in the market portfolio. Then you can have the portfolio where you are borrowing from the risk-free rate, using the risk-free rate and investing in the market portfolio. So your return will keep increasing, but simultaneously it will also increase the risk also. This particular region, I'll change the color. Okay. This particular region is the lending portfolio above the tangency on the capital market line. The capital market line's portion above this tangency portfolio is the borrowing portfolio because you are borrowing from the risk-free rate, at the risk-free rate, and then you are investing. This particular region is known as a lending portfolio because you are investing some portion of the asset in the risk-free asset. When you are making the deposit, it's kind of a lending. That's why we call this as a lending portfolio. So this region is the lending portfolio. This region is the borrowing portfolio region. Now, the question is why this and this are not considerable, because remember, if you want to create your capital market line with this particular portfolio, no one is going to invest in this. people will prefer this particular portfolio, right? Because it is not giving you the optimal allocation. Sorry. And if you want to invest or create your capital market line using this, it is also not possible because there is no such portfolio in this universe. So you can't invest in this portfolio because there is no such portfolio. You can't invest in this particular portfolio because this portfolio is not optimal. Ultimately, you are left with this particular portfolio. That's why you get the capital market line, which is tangent to the efficient frontier, not the minimum variance. Remember, it is not tangent to the global minimum variance. It is tangent to some other portfolio, which is the optimal portfolio. This is the optimal risk portfolio, market portfolio. And why we are calling this as a market portfolio? Because we assume everyone will invest in this portfolio only. Then we have the capital allocation line. The capital allocation line is the line which shows all the risk return combinations from mixing risk-free asset with the risky portfolio. Each risky portfolio generates the different capital allocation line slopes. And the slope of the capital allocation line is equal to ERP minus RF divided by sigma P. ERP minus RF divided by sigma P. Optimal risky portfolio is the one where the capital allocation line is tangent to the efficient frontier. And this is the capital allocation line. And see this. This is the capital allocation line. Capital allocation line, if you want to remember what is the meaning of this capital allocation line, how you allocate your capital is the capital allocation line. That is the difference between the, like, how much you are investing in the risk-free asset versus the portfolio. Remember, here I am not using the word market portfolio. In the portfolio, there is a capital allocation line. Here, expected return, standard deviation, and capital allocation line. At this particular point, this is standard deviation of the portfolio, and this is the your ERP, and this is the portfolio mix of risk-free asset and the risky asset. No, this is yeah. Then you have the RF. Then you have this particular point, portfolio of the risky asset, pure risky asset, and this is the expected risk of the portfolio, and same thing. Okay, just remember this. As you increase the allocation into the risky asset, it will, like, the standard deviation of the portfolio will increase. Then we have the capital market line. Now the capital allocation line and capital market line is same. If you see, the x-axis and the y-axis are same here. The different, and also it is about the allocation in the risk-free asset and the risky asset. Now the difference between the two is, remember, here in the capital market line, you are taking the capital or the market portfolio as your portfolio. And in the capital allocation line, you are taking any random portfolio as your portfolio. And then you are creating the combination. Okay. Capital allocation line, any random portfolio with the risk-free asset. Capital market line, market portfolio with the risk-free asset. So if you get a question, which market line or which line will give you the tangency portfolio with the efficient frontier, it is the capital market line. If you have the line like this or line like this, these are the capital allocation line. The line, remember, the capital allocation line, and this is also the capital allocation line in a way. But because it is tangent to the market portfolio, we call this a capital market line. Now, capital market line is the special case of the capital allocation line where the investors have the homogeneous expectations, and the expectation is the market portfolio, investing in the market portfolio. All the investors select the same optimal risky portfolio, that is a market portfolio. And capital market line is tangent to efficient frontier at the market portfolio. Capital market equation is this equation. You don't have to remember the equation. And then we have the passive and the active strategies. Passive strategy is hold the market portfolio plus the risk-free asset aligned with the capital market line. Active is deviate from the market weights and exploit the perceived mispricing. Okay. So passive investing is the as per the capital market line. Active investing is the deviating from the market weights. As simple as that. Again, we will have the detailed discussion on the passive and the active in the level 2 and level 3. For level 1, this should be sufficient. For your understanding, here I provided the difference between the capital allocation line, capital market line, security characteristics line. Remember all these differences. Okay. And this is the end of our discussion. This is how we are able to finish our whole revision of portfolio risk and return 1 and 2 in 1 hour. And if you have any doubts, you can comment in the comment section. Okay, you can ask me queries in the comment section. Thank you, and thank you for watching this video. So in the next video, bye bye, take care.